Welcome to my channel. I'm going to show you step by step how to value a stock. At the end of the video, we're going to look at the company's financial ratios, leave a comment, and I'll be sure to answer. The company we're going to look at is Tecsys, which trades on the Toronto Stock Exchange. It was founded in 1983. It helps businesses with supply chain technology and supply chain management. Let's get started with the model. This company has a market cap of 403.8 million Canadian dollars. So it's a small cap company. It's always a little risky investing in a small cap company. Trading at $28 a share. And the way you value a company is you estimate the future free cash flows and then discount that number back to today's value. That's exactly what we're doing in this video. Now I'm going to pull their actual free cash flows. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are investments in property, plant, and equipment, like buildings or machinery. Next, we're going to pull the net income, which is a profit and loss on the income statement. And then we're going to pull the revenue also on the income statement. These are the sales for the company. Let's look at the numbers. Free cash flow looks pretty steady year to year, and it's positive. They had 1 year of negative net income, and their revenue is going up every year. It had a nice pop from 2019 to 2020. Everything looks pretty good so far. Let's look at a capital structure. They pay $1 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liability section. Current debt of $1.2 million. Long-term debt of $9.6 million. Interest payments on debt is tax deductible, so let's get their effective tax rate. We'll go back to the income statement. Income before tax of $3.5 million. Income tax of $1.2 million. So they pay 35% of taxes. Cost of debt is 6.5%. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. The beta is 1.17, so the stock is a little more volatile than the market, but it's not too risky, it appears, from the beta. Let's go back to the financial statements and get their current assets. We need just to calculate the current ratio later. Current assets is $67 million. And that's $37 million of cash, $18 million of net receivables. That's how much money is owed to this company, and $1.4 billion of inventory. Current liabilities is $42 million, and that's made up of current debt, $1.2 million, $16 million of deferred revenue. Deferred revenue is when you receive sales in advance of delivering the product or service. But when you actually deliver the product or service, then they take the money off of deferred revenue off the balance sheet and put it onto the income statement. Other current liabilities of $4.7 million. Equity of $61 million. That's the value of the company according to the balance sheet. $40 million of common stock, $8.8 million of retained earnings. Retained earnings is the income of the company that's not paid out as dividends. And $416,000 of accumulated other comprehensive income. We also need the operating income. That's $5.1 million. We need this number to calculate the interest coverage ratio, which we'll do later on. They have 15% debt. Cost of debt is 6.5%. 85% equity. Cost of equity is 11.3%. And the WACC is 10.6%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $298 million. We discounted those numbers back to today using the weighted average cost of capital. That's here in green. We get a value of the company at 215 million Canadian dollars. And if we divide that number by 14 million shares, we get an intrinsic calculated stock price of $15. They're trading at $28, so they're trading at an 88% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're at $26, so they're saying the stock is a little overvalued, but not nearly as much as mine. We all use different models and have different assumptions. My model may be a little more aggressive than Simply Wall Street's. Let's see where the stock has been trading. So it looks like it's been really driven up the past few years and it's almost at its all-time high. Seems like a stock that could do well during coronavirus because companies will probably want to become more efficient by improving their supply chain management. Let's look at the financial ratios. Terrible PE, terrible price to sales, and a terrible price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 172. Investors are paying $172 for $1 of net income. That's a really bad ratio. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, there at 3.9, so investors are paying $4 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 6.6. So investors are paying $6.60 for $1 book value. Good current ratio, good interest coverage ratio, and a weak ROE. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.6, so they can cover their current debts and payables. ROE is net income over equity, and they only have 4%. I like to see above 20%. So they're not providing much net income relative to the equity on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. And the best way to look at ratios is to compare them to similar companies. I've done videos on Datadog, Intuit, Tecsys, Mogo, and The Trade Desk. And I've done two Canadian companies, Tecsys and this video here, Tecsys. And if Tecsys has a number in green, they're better than the average in the industry. If they're in red, they're worse than the average. So in terms of PE, they are better than the average just because Datadog has such a big negative and it drags down the average to negative. Price to sales, they are better than the average. So that's how you have to look at the ratios. You can't just look at them in isolation. You have to compare them to their competitors, and then you'll find out if it's good or not. And as you can see, the rest of the industry is really struggling. Even though I said Tecsys has a bad price-to-sales ratio, they're actually good relative to their peers. They have the best price-to-book ratio in the industry. So I was quoting you on what I expect the average company to have, but you should always focus on what the industry has, and they're the best, so that's a good sign. In terms of current ratio, they're worse than the average, but they're doing fine at 1.6. ROE, they're better than the average because Mogo has such a big negative at bringing the average to negative. They are lower than the average in debt, but everybody except Mogo is doing really well in terms of debt. And in terms of market cap, this is a really small company. When I convert it to US dollars, it's only 303 million, and the average in the industry is 20 billion US dollars. So let me know what you think of the video. Leave a comment, I'll be sure to answer. Thanks for watching.